A tender offer isn't just a corporate transaction. It's a moment of reckoning for every investor who once held onto a vision. MerryMart's shareholders now face that precise crossroads. Back in June 2020, the story was compelling. A local grocery chain, helmed by Edgar Sear II, the man behind Mang Inazel's meteoric rise, was listing during the depths of the pandemic. The promise, national expansion and growth, fueled directly by IPO proceeds. Investors weren't buying someone's exit, they were seeding future potential. Just a few years later, that optimism has been repriced. DoubleDragon steps in with a tender offer at 48 centavos per MerryMart share, barely half of the IPO price, and a fraction of where the stock once soared in early 2021. For anyone who bought at the peak, the numbers are sobering, a decline of almost 94% from that January high. Why such a sharp turn? MerryMart's journey tells a familiar tale in markets, a cycle of hope, frenzy, and disillusionment. For a time, the company encapsulated what investors wanted: resilience amid crisis, a trusted founder, and the possibility of quick expansion. But as new numbers rolled in, net margins compressed, profits modest, the growth narrative cooled. Essential retail is stable, but there is a difference between being necessary and being highly profitable. Now, DoubleDragon offers a two-part deal. Half cash, half shares issued in DoubleDragon itself. The offer price, supported by an independent fairness opinion, aligns with MerryMart's recent performance. The arithmetic, however, is far less comforting for those who remember the IPO's hope or the peak's euphoria. For every peso invested at IPO, the exit returns less than 50 centavos in cash and shares, an unmistakable capital loss. There are, of course, strategic threads. Merging MerryMart into DoubleDragon's broader ecosystem, spanning malls, offices, warehouses, and hotels, has its logic. The offer promises the same terms to all, treating small shareholders like controlling insiders. Yet, tendering isn't a pure cash exit. Half the consideration arrives as DoubleDragon shares, not immediately listed. Their future value is, as ever, market-driven. The offer forces a choice. Do you accept the loss and swap for a more diversified holding, or stay with MerryMart, now closely tied to DoubleDragon's fate? Holders who ride out may face thinner trading and less visibility, but perhaps also the prospect of future synergy within a larger group. For some, this is simply an exit, transforming a paper loss into a real one, but closing the book. For others, it's a hard lesson in the difference between a good story and a good investment. Yet for all, it is a reminder: the market can amplify dreams, but only execution and earnings can sustain them. The tender offer is not the end of retail dreams. It is, however, the revaluation of hope through the lens of reality.